Happy Saturday, everybody. I'm Scott Davis with Cross Country Mortgage, and today we're going to get into a little bit of refinancing and rates and terms. With everybody talking about how low rates are, historically low rates, I'm getting a lot of calls about dropping the terms from 30 down to 25, 20, or even 15. And that might not be the best option for a lot of folks. I'm going to go through a quick little exercise with you right now, and you can forward this video on to anybody that you think might need this. I'm going to use a loan amount of $400,000, and we're going to use rates, today's rates, 2.625. And the funny thing about rates today, the 30, the 25, and the 20 all kind of price right there in the same range. But when you get down to a 15, you see a pretty good drop. So for the 15-year fixed, we're going to use 2.375. And these rates for this exercise, no points, no fees, extra fees, or anything like that. So we're going to look at 30-year fixed, we're going to look at 25, 20, and 15 real quick on all of these. So if we're looking at a principal and interest, and we're only looking at the principal and interest portion of the payment. We're not counting escrows, which is taxes and insurance, or the HOA as well, because rates only affect the principal and interest part of this process. So if we have a $400,000 loan for a 30-year fixed, we're looking at a payment of $1,606. At 25, that payment is going to go to $1,819, and a 20-year fixed jumps up to $2,144. And then lastly, we're going to go at $400,000 at 2.375 for the 15-year, and we're going to see a pretty big jump on that. So that's going to go to $2,643 a month. When you look at the interest savings in these, that's really what we're going to get into. But first, we're going to take a look at the delta on these payments. So at 1606, we drop it to a 25. We're looking at a savings of $213. Then we drop to the 20. Now we're at $538 in savings. And then a 15-year, we're going to see some pretty substantial savings there. So that's $1,037 difference from a 30-year fixed. And on the surface, this looks great. We're saving a lot of money monthly, and you're going to be able to sock that away, and your home will be free and clear. But when you have a free and clear home, what that means is you have a hopefully $500,000 home that you've got that $500,000 locked up into a non-equity bearing savings account. You're not getting anything from that. And that's what we're going to talk about here today. So the interest that we have here, and again, that's the important part, how much interest we're paying on these. So we're looking at a 30-year fixed, we're looking at $178,000 in interest, and we drop it to a 25, and the interest over 25 years, which is 240 months, the interest you're paying is $145,000, which is nice. You see a drop there. Now we're going to 20-year, and the 20 years what we're going to look at a little further, and that's about $114,000 over the course of 240 months. And then lastly, the 15-year, we're looking at $75,000 in savings. And again, you're looking at paying $178,000 or $75,000. You think, oh my gosh, it's a no-brainer. Let's do the 15-year fixed. But this is an example of why this might not be the best idea for you. So the delta here on the savings, so we're taking $103,000 savings from the 15 to the 30, and then $64,000 we're saving there, and we go to the 25 over the 30, and we're looking at $33,000. All these again seem like great options on the surface. But what we're going to do is we're going to take this 20-year fixed and this payment and this savings versus the 30-year, and we're going to kind of take an average investment return of about 7% annual, and we're not going to look at daily, weekly, monthly, but year over year over 20 years. We're going to use a 7% return. So if we invest this money and we get a return at 7%, and we're going to say our monthly payment is going to remain at $2,144, we're gonna do the 30-year fixed. So our mortgage payment is $1,606, but our delta is $538. So we're gonna send that directly to our investment account. So over 240 months, we're investing $538 a month. So over the period of 240 months, we've invested this with a 7% return. So now what we have is $282,000 in an investment account. So after 240 months, our loan balance, which was $400, has now dropped to $169,000 after it amortizes over that 240 months. So on a 20-year fixed, after 240 months, this is zero. But now we take this 282 that we've invested, we subtract that, and that leaves us with $113,000. So by keeping that exact payment that we wanted, we've paid off our house in 240 months, but we're also put $113,000 back into our family's investment account for the future. And this is how we build wealth. If you have any questions or any concerns about this, or if there's someone that you think would benefit from this, please give me a call. Scott Davis with Cross Country Mortgage. Thanks, everybody.